We have an information on item on number 3. That's the disclosure of the incentives for statutory positions for the 17-18 plan year. Are there any questions about that disclosure? Does staff want to say anything? That's just for information. So we'll move right on to number 4. Melissa, this is our labor marketing benchmarking study update. I'm going to let you tee that off, Melissa, if you would, for us.
Sure. Good morning, everyone. So this really is just to inform the committee that staff is initiating your biennial labor market analysis. Those are for the positions that are covered under the board salary setting authority. So those are all your investment management positions, your CEO, your COO, CFO, general counsel, and system actuary positions. We have partnered with McLaughlin and are requesting their assistance with the analysis. And the analysis will provide the total compensation results. So that's your salary range as well as your incentive pay. If you recall, the last analysis was conducted in April of 2017. And at that time, the committee made some updates. And they were to establish the COO and the CFO salary ranges, as well as the incentive opportunity eligibility. And they adopted a new salary range for the general counsel position, as well as a new salary range for the portfolio manager position. The results of the analysis will come back to you in May of 2019. Many of you know Michael Oak. He will be here to present those results to you. And if there's any questions that the committee has of me relative to the analysis, I'm happy to hear those now.
Melissa, somehow I lost my chairperson screen. Okay. So let me get that booted up. If anybody has any questions, I can just...
I don't have a screen
Thank you, guys. I don't think anybody has questions on it. Okay. Thanks. Now, when I went to load it, it gave me load project and then do something else instead of that. Okay.
Oh, sorry.
All right, no worries. I tried to open it on my own. All righty. So it means we have no questions on that. When we come back with that study, that's going to be in?
May of 2019. Yeah.
All right.
And I think it's nice you've been doing these now. Well, this is the second time doing it on a biennial schedule. And I think it helps support the committee in really keeping current with competitive market and also kind of closing that gap in seeing those really large variances in pay that you saw in 2013. So hopefully that's been helpful to keep it on a regular schedule.
Super, thanks, Melissa. Then moving on to number 5, the incentive benchmarking setting process. So educational, we did invite the whole board to this. Melissa, let's go ahead and have you tee that off.
Sure. So as you recall, this education session was added to the compensation committee work plan for 18-19. And it was really reflective of refreshing the committee's understanding of what the process is for adopting benchmarks into the incentive plan once they are reviewed and approved in the investment committee, as well as what are others doing in this area relative to benchmarking and best practices. To the left of me is Luis Navis, your primary compensation strategist. And next to him is Alan Imkin with PCA, your investment consultant, and Stephen McCourt with Makita. They all contributed to this presentation you're going to receive, as well as Neil Rue, who's not here, with PCA. And so they have a tag team approach in presenting this information to you. And I believe I'm going to hand it over to Stephen first to kick it off. And let me
Great.
pass that.
Thanks, Melissa. And just by way of overview on the presentation, this is intended to be a sort of 30,000-foot glance at your current benchmarking process and observed market practices. in the marketplace. If the committee is interested in kind of further detail, further discussion, dialogue, we can obviously agendize additional thoughts at other meetings. I'm going to kick it off on slide number 2. And the three of us, me, Alan, and Luis, will go kind of back and forth through these slides. But the first item I wanted to highlight, and you've all heard this from us on the investment committee, that the term benchmarks and the way people use benchmarks is a more complicated topic than most people perceive. Benchmarks can be used for lots of different reasons, and depending on the type of benchmark you select, the data that you gather from a benchmark or returns relative to a benchmark tell you very different things. And so the selection of benchmarks is an important decision that policy boards need to make. And so what I've listed here is just a few ways in which some people think about benchmarks. One, defining the broad investment opportunity set for a board and staff, tracking broad capital market performance, aligning the expected risk and return from asset allocation policy with the execution of that policy, measuring staff performance in executing the policy that you've adopted, and measuring the effectiveness of the asset allocation policy with other alternative policies. All of those are very valid questions that policy boards ask themselves, and questions that benchmarks can help answer. But each of those questions would be answered by a different flavor of a benchmark, a different type of benchmark that you would use. So as we sit here, at a compensation committee, we're thinking about benchmarks from a compensation perspective. At an investment committee, we could be thinking about it from an investment perspective, and you may have different types of benchmarks and different interpretations of benchmarks depending on the context in which you use the term.
Good morning, Alan Emkin, PCA. I figured out how to work the clicker. I start off well. First and foremost, I want to underscore that the three of us work for the board. We don't work for the staff. We work with the staff, but we work for the board. And there's a lot of communication with the staff, and we couldn't do our jobs regarding benchmarks without talking to the staff. But the goal is to meet your objectives, not theirs. Their objectives are defined by you, and it's very, very important to keep that in mind. The other thing, from a macro perspective, benchmarks are there to help you measure things, because if you can't measure them, you can't manage them. And your role is in oversight. To do that, you need the information to help you make decisions. So there are two types of consultants regarding this process. There's the investment consultants, Steve and myself, and our teams, and the compensation consultants. Very different roles. The role of the investment consultant is really rather constrained. It's to recommend benchmarks, and almost universally, those are very well known, particularly for the public markets. They're available every day in the Wall Street Journal with minor edits. And if there's a challenge in benchmarking, it's those asset classes or those strategies that aren't marked to market on a daily basis. It's the private markets that really pose the problem. We give you suggestions on which benchmarks to use and the rationale for those benchmarks, and we give you our opinion on what's appropriate. There's probably a lot more consensus about benchmarks than you would ever realize across the institutional community on the public markets. Where there tends to be diversion is in those things that aren't marked to market on a daily basis. Luis, we didn't discuss it. You want to talk about the comp? Or you want me to talk about it?
Go ahead.
The compensation consultants really help you understand what's going on in the marketplace. What are people doing? How that, if it changes, how it will impact compensation, and really looking at compensation in terms of how do you motivate people, how do you attract people, how do you keep people, how do you create the right attitude, and then measure that and see if in fact the compensation scheme is generating the type of activity that is meeting your objectives. And I'm going to constantly go back to your objectives. The whole reason to do this is to give you the tools and the information to make thoughtful decisions on compensation.
Thanks, Alan. So I think some of you have heard me say this before, that too many organizations focus on just the compensation side of the decision-making process. And I think what we've always tried to do at CalSTRS and with all our clients, frankly, is to realize there's really two sides of it. So it's not just determining what is a competitive opportunity, and I call it opportunity, but related to that, what's the carrot? What is that? What is the performance measure or the performance level required to earn that opportunity, that compensation opportunity? And it's important to look at that also within the risk profile of the organization. So in terms of CalSTRS and what this committee looks at in terms of reviewing and approving, beyond, obviously there is the bucket that we're not talking about today, but just want to make it clear that it's that whole, salary, the compensation opportunities. But just as important, if not more important, as it pertains to the board, is what are those benchmarks required to achieve that compensation opportunity? You want to make sure that at the end of the year, when compensation levels are being communicated to your stakeholder group, that there's that balance in terms of pay performance and a good linkage. So you're looking at, as a committee, you're looking at the investment performance benchmarks. You're looking at the bogeys, and so just for clarity, some people use the terminology bogeys. Others refer to it as the value add. So just, again, maybe just if it benefits just to go through an example, if you're looking at, say, total fund performance, and you're measuring that against, again, a major index, you're kind of saying, in order for you to trigger your bonus payout, you need to get X amount of basis points above that. And then you'll set that, in terms of different levels of performance based on different levels of pay. And then you're also, as a committee, getting involved in setting the weightings, both in terms of qualitative and quantitative. And I think, Alan said it a few times earlier, it really, when you're looking at those weightings, it goes back to what is it that you're trying to drive? There are some organizations that overweight on quantitative, because that's really what they're wanting to motivate and drive. There are others that go the opposite way. But for the most part, certainly been our experience that those organizations that are in the asset management sector and field are trying to put more weighting on investment returns. In this case, meeting the pension promise. On the next, So the next slide, kind of touched on it already, but in terms of the previous slide was more around in terms of the kind of the micro elements of the comp plan design. In terms of who you're covering as an organization, you're covering everybody. And I think if you were to make a comparison to, say, a publicly traded company, it'd be fairly normal for a board to set out to say, okay, in terms of the macro level design principles of the compensation plan, we want to make sure that it runs through the entire organization. I think the last thing you probably want is to only focus on saying, we want to set out investment measures for just the CEO and the CIO, and then you have, kind of a rampant issue throughout the organization where other staff aren't aligned to their goals. So in the case of CalSTRS, you've got this kind of perfect alignment of saying it's starting with the measures that you're applying to the CEO and CIO, but that's getting filtered through to all staff. Back.
This committee and your board deals with this issue on a regular basis. There's nothing new about reviewing benchmarks. Sometimes it's pretty simple, and sometimes it's really pretty complex. Over the last 4 years, you've had 9 separate and distinct benchmark reviews which PCA's incorporated. Each one of those has addressed the quantitative or the number, which is truly the easiest part, the qualitative, which in our opinion is really more important in many ways, assuming that the quantitative is reached, because the qualitative deals with, are people working as a team? Are they providing leadership? Are they setting a good example? Are they fostering the value of the institution? Crucial. And then looking at that incentive package to see how it fits into total salary. It's important to keep in mind that financial services industry, traditionally, disproportionate percent of income comes in a bonus. So a partner at a big investment bank, big number for a public employee, but they might have a base salary of $200,000 or $300,000. They might make $10 million a year. It's all based upon their performance. They're not public employees. They have a different set of motivations. They have a different set of values. And so that's not necessarily the best model. And having had these conversations with a number of public plans across the country, I always say one thing: I don't think your staff would work any harder if the compensation scheme was all base salary with no bonus scheme. I think they're working as hard as they can. I think they're really committed, and that's across the board. But if you look at history, the whole bonus scheme came about because of the challenge in public agencies of having base salaries outside of sporting events for public colleges, where they're willing to pay very large compensation as a base salary. For some reason, that's okay, but being the CIO for CalSTRS isn't. It's more important. But it's important to put, I think it's always important to keep that in perspective. I go back to Kansas, and the staff there doesn't make nearly as much as people do in California, but the basketball coach at University of Kansas and the football coach at K-State do really, really well by anyone's standards. Yeah, but I'll let you be the judge of that. What should be the premium or the bogey? There's no magic. Reasonable people come up with different numbers. The key is it should be a number that's attainable. And that's a back and forth process, because you don't want to have the wrong incentive. If that number is too high, then you're incentivizing people to take risk. And all the discussion this board has had about risk, that's not what you want your staff to do. You don't want them to make big bets. They're making bets at the margin. And then it's our role to help you figure out which benchmarks work, and then in terms of the total portfolio, weighting those so you have a total fund benchmark. So we did 9 reviews. 3 of them, we came up with excess return or premiums, or however you want to call the amount above the benchmark. And they've changed. And they've changed because of your action more often than not, or they've changed because market conditions have created something that we brought to your attention. The best example would be private equity, where there appeared to be a benchmark which really wasn't meeting its objectives. And to say that in our industry, there's a consensus on what the right benchmark and bogey is for private equity would be a complete misnomer. It doesn't exist. There's no agreement.
Are you just talking, Alan, about benchmarks for compensation?
No, not really.
Because all of this seems just focused only on the question of compensation as opposed to us overseeing investments and saying, are we doing as well as we want to do? Measuring the performance of the fund, because that's what we care about as fiduciaries, is how the fund is doing. It's very important that we have a good compensation system, but our benchmarking shouldn't be driven by compensation system. Our benchmarking should be driven by the fact that we're fiduciaries and we've got to get the best returns and we've got to measure whether we're doing that. So it seems to me that everything here that we've talked about so far, and maybe we're going to get to something later because I appreciate what Stephen said at the very beginning, which is there's a whole lot of different reasons for benchmarks. And I'm hoping that that's what we're going to kind of be exploring here is how to reconcile those. But this seems very focused on compensation.
It is. We couldn't agree with you more. We are investment consultants. We're not comp consultants. So I would hope that we would focus on the fact that the only reason you have an investment portfolio is to meet future obligations, because there's a recognition that unless you generate certain levels of return, you won't have the assets to meet liabilities. So that's driving it. The emphasis of the presentation so far, because this is a comp committee and it was designed to address that, so, but I agree with you completely.
Right, I mean, stepping back, there was, you gave a little history of what the investment committee has done, and I'm sorry the investment committee leadership isn't here, because I think it's very important. But we made a lot of changes to the benchmarks, but they were all driven by a desire to change the benchmarking for compensation purposes, not for the purpose of evaluating the performance of the fund.
So Paul, instead of having our consultants respond to that, I think that's probably a matter of perception. And I think right now what we're doing here is talking about how we've done it. I think that as we go through the presentation, we're going to tie how the benchmarks, when they're set in investments, affect compensation. And what we want to try to do is figure out a process and how, when a benchmark is set in investments and it's set for the purpose of, and I'm not going to put it as eloquently as you do because that's more your world, but performance, and not necessarily performance for compensation, but performance for the health of the fund. How do we move that then into compensation, because it definitely affects compensation? And what we want to try to do is make sure that we move away from the specter that those benchmarks are being set for compensation, because I don't necessarily agree that that's why we changed the 9 that Alan spoke about. So I think we're going to get into that.
That's fine. I just want, as we go through it, to be clear about what we're talking about, because
Absolutely.
because I think those 9 changes
I know.
were for compensation purposes, and if they were for us trying to be stewards of the system, they would have been different. I mean, I'm not saying it's an easy issue. I mean, that's why we're
Absolutely.
here, that we make compensation decisions by measuring performance over a shorter period of time than our investment staff always says we as a board should consider when we look at the returns of the system as a whole. That creates, I think, real problems for us. And I'm hoping one of the things we're going to do today is help get a way to reconcile that. So that's all I'm saying. I want us to be clear about, when we're talking about a benchmark, where we're fitting in Stephen's first page, because otherwise I think we lose clarity and we get no benefit from this conversation. That's my request. Thank you.
And I think we're going to go there.
Good.
All right. Go ahead.
So, and again, for clarity, GG is not, we are not investment management experts. That these two gentlemen to my left, that is their expertise. What we, and I think this first point actually somewhat touches into Paul's point, maybe not perfectly, but it does touch it, is what we do regularly for CalSTRS and all our asset management clients that I think more organizations should be doing is taking a look historically and analyzing kind of the hit ratios for the compensation achieved based on the benchmarks being used. So for example, you don't want to be in a situation where you're hitting your measures 95% of the time. If you're hitting your measures every year for a long period of time, there's probably something wrong in the design. Either you haven't determined the risk profile correctly, or you haven't picked the measures correctly. It doesn't mean that it doesn't sometimes happen, but if it's happening consistently, then you're probably not, either again, setting the measures correctly or the value adds correctly. Something's wrong with the design and that. So there are elements that we look at when we do the first bullet to say, okay, over the last 10 years, if you look at the different asset classes, and again, we're looking at it from a compensation perspective. We not just look at kind of how many times you've hit the specific asset classes, but then also what is the relative compensation that you're rewarding for that. But that's an important part of, the process that we follow. In terms of, we've looked at some of the jobs that have come forward where the board, would like a little bit more information around what's the appropriate hurdles for those jobs. Again, we look at it from the GGA side solely from a compensation perspective. We let the other parties at the investment committee level look at it from the point that Paul was making. We do get involved in providing recommendations around the appropriate weightings around the quantitative and the qualitative components. Every organization has their own philosophy around the weighting. Our philosophy, which I think is more your philosophy, you can't be overweighted on the qualitative side, because in terms of the message at the end of the day that you're trying to deliver to your pensioners, it's kind of hard to justify a high or attractive pay level if the pensioners aren't necessarily seeing the benefit of that. And the only way they're going to see the benefit of that is if there's a greater weighting on the quantitative side of the calculation. This last bullet is something that we took over from Aon, I guess it was 2 years ago. And it's something that happens behind the scenes that I think is an important part of the process to make sure that there is an independent eye on the macro level calculations. So management goes through the calculations of calculating the incentive payouts relative to the quantitative and qualitative benchmarks, creating the macro bonus pool, and then the individual payouts job by job by job. So what we do is once they've done that, we go through a detailed process to evaluate to make sure that the correct measures are being used, the correct numerics are being used, the correct calculations are being done, and then we attest to that to the board, and we do that independently. So that's kind of just a broad overview of kind of the things that we do as a firm as it pertains to the topic of the investment benchmarking process. Thanks, Alan. So in terms of the pros and cons as to how CalSTRS' approach to this is purely from a compensation perspective. So you're covering all eligible staff. And I think some of the pros to that is that, you know, you've got full control over the performance expectations. We think that's a big deal where, again, as I mentioned earlier, I think you want to have that control. You don't want to have kind of an inconsistent performance measure being used throughout the organization. It's easier for people like the CEO and the CIO to achieve their goals that this board has given to them if everyone below them has a consistent goal also in terms of the measures and such. There is kind of that, you know, independent review along the way. As Alan mentioned, at the end of the day, we are all hired and fired by this board, and that's an important point. In terms of the cons, unfortunately, it's, you know, it is the life of the director of any board in that, but there is a lot of time that then therefore goes into, you know, covering all of this to make sure that those benchmarks are accurate, that they're reflective of external market practice, that they're reflective of the risk profile that you're hoping to achieve, and that at the end of the day, that, you know, that pay for performance alignment, when you communicate it to your stakeholder group, feels right, right? You know, that there's no doubt that, you know, for, you know, the average CalSTRS employee, you know, that teacher, that the pay levels are nowhere near what they're earning. And so you need to be able to say, you know, here's the communication, here's the story, this is why it makes sense, this is why it's fair, and it's good for you. And the last point on terms of the con is it does reduce the level of control that the CEO and CIO have over the updates. You know, I think you have to weigh that against, you know, the consistent measure. But as you'll talk about, you know, later on in some of the slides, you still are giving some autonomy to the CEO and the CIO as it pertains to some of the weightings around and the evaluation around the qualitative side. But again, I think having that consistent theme and message on the quantitative side, in terms of what really drives value at CalSTRS, is very important that it hits on every level in the organization.
So talking about not just what you do, but what others do. Start with the total fund. First, it's really important to remember that it's not just return that we care about or you care about in terms of benchmarks. It's risk and return. So if you got a certain level of return, but there was unnecessary risk, that would be a violation of some policy and would impact performance, and it would impact compensation. You, when you're sitting as the investment committee, you make the asset allocation decision. And part of that asset allocation decision-making process is the selecting of asset classes and expected risks and returns for each one of those asset classes. And in fact, that determines what the overall policy benchmark for the total portfolio is. X amount of public equity, X amount of bonds, X amount of real estate, et cetera. Those get combined and you make a policy decision on what the strategic asset allocation will be, which gives us an expected rate of return, an expected level of risk against which the portfolio is measured. And each one of those benchmarks has a unique component of risk and return, which is eventually reflected in the individual benchmarks and varying weights to different employees. So you do that. Each asset class has its own benchmark. And the public markets are easy. The prices are available on a daily basis. They change second to second. You can open up the Wall Street Journal and find out what happened in the bond market or the stock market or the international market. And the industry-wide, they're generally a pretty narrow range with some minor tweaks, and the tweaks reflect decisions that you've made. So to the extent certain group of securities is not included in the opportunity set, that gets reduced from the benchmark. So there's a minor customization. But all of those combined still mean your benchmarks look like the broad market in all the public asset classes. The challenge is in the private markets. And that is, we have an estimate, and which is when we talk again next year on asset allocation, what kind of premium should you expect from private equity? I know we're going to get a lot of good comments on this, and we think the premium's going to go down. And so that eventually would be reflected in the benchmark. But it's important to keep in mind that's driven by the strategic decision on how much weight to that asset class, given the assumptions that go into the asset allocation decision-making process. So you do that, and what you do there is very similar to what the industry does. There's no big exception. Customized benchmarks. To the extent that the investment committee makes changes to the opportunity set, those should be reflected in the benchmark. So if you cannot own a whole class of stocks, that should be reflected, because you can't give someone a benchmark for something they can't do. But with those very minor exceptions, the public markets are easy. You make those minor tweaks. It's the private markets that really demand customization to reflect both your size, your resources, the board's belief in how much can be added in terms of value, and how they want the portfolio to be managed and types of risks that they're willing to feel comfortable with within each asset class. The public markets, as I said before, are relatively easy. There's very little discussion about those. The challenge for you and for your peers is really in private equity and real estate and timber and infrastructure, which are not publicly traded, which you don't get regular prices on, and which are used by an appraisal basis for pricing, and it's lagged. So there's all sorts of complexities, but the way you've approached it is very similar to what most of your peers have done to one extent or another. I don't know anyone who's done anything really dramatically different, and I defer to Steve, but pretty much people are using a pretty narrow band of alternatives to come up with benchmarks for private markets.
Thanks. So look, I want to talk a little bit more about sort of the customization of these private market benchmarks, because I think we had a sort of the experience a little while ago when we were making some changes to the private equity benchmark, where the question is the benchmark driven by what staff decides to invest in, or should the benchmark be driven by the universe of what this board says the staff can invest in? And we had that debate because it came back to us that there was a suggestion to change the benchmark and narrow the benchmark to more reflect exactly what staff decided to invest in, even though there was a broader universe of things that staff could have invested in. And we made a minor change. There was some change, relative to what staff and what our consultants recommended. This board did ask for a change, and so it was modified slightly. But how do we define the universe of what's possible, so that then we incentivize staff to actually, in other words, the whole idea of benchmarks is to incentivize staff. It's not to confirm that staff has done something right. So if you say, if staff says, well, we've invested in this asset, and then we say, well, that's the benchmark, then of course they're going to meet the benchmark. But if we say you can invest in 50 different assets, you can only invest in 5, but there's a universe of 50 you can invest in, the benchmark should be the 50, it shouldn't be the 5 that they choose, right? So how do we make sure that we do that? Because I think we're not always there.
Well, I'm going to encourage Steve to participate, but I believe that the benchmark should be the opportunity set, which is what I think you're arguing,
Yes.
with some recognition that your size may well constrain your ability, particularly in private equity, that you probably can't do a full weighting and use venture capital as the example.
Right, okay.
And so there should be some reality test on what the opportunity set really is. But once you've done that, then I agree with you, it should be as broad as possible, with one caveat, and that is, in private markets, timing is crucial. And you don't, it's not like the S&P 500 where you invested that money on day one, and you can really know what happened just looking at time-weighted rate of return. Depending upon when you put the money to work, it can have a dramatic impact on what the total portfolio's return is. So if you made your big bet right before the financial crisis, which many large institutions did, on average, you would probably overweight bad years, and so you would end up looking very bad relative to that index. So there should be some recognition that there is a timing issue involved in private markets. But that being said, the broader the opportunity set that they could use should be, in my opinion, what they should be measured against.
So, let me just, if I can make one more comment, then I'd love to hear from Chris on this. So then in the timing thing, let's say, we have, with every asset class, we have a range. We sort of say, okay, we should have a 10% allocation here, but it can be between 9 and 11 or whatever. That's in our policy. So shouldn't we hold staff accountable for timing as long as they stay within our constraints? In other words, shouldn't we say to them, if things are looking bad, you should be at 9% rather than at 10% or at 11%, and you'd be violating our policy if you went below it. So you should come and tell us that you want to be below it and why you want to be below it. But again, it seems to me that the whole point here is that we set a menu of what staff can do. They can be from 9% to 11%. They can be in, all of these different sort of strategies, and I'll just use private equity, we could use real estate, we could use any of the other private asset classes. And then within those constraints, we hold staff accountable for how they do. And you're mentioning another issue which we've got to get to. It might not be the right time now, but it is the timing in terms of over what period of time do we measure performance. And we have a tremendous, I think, tension, because there's no question that sort of the right thing to do is on these private asset classes to say we can't measure performance except over a long period of time accurately. And yet we have to report results every year. Every 6 months we report results. We have to pay compensation on a much more shorter time frame. We can't say to somebody in private equity, we'll wait around 10 years and maybe we'll pay you for this investment you made today. That doesn't work. So that's going to be a separate question that I think you're raising with the timing. But I'm more concerned right now about sort of making sure the benchmark reflects the opportunity set rather than the decision that staff makes.
We would agree that that should be what drives the decision-making process, but just in terms of the private markets, particularly private equity, but also real estate for CalSTRS, the staff didn't make the decision to make the big bet on private equity and real estate in the middle of this decade, the previous decade. That was made through asset allocation. And so the money that really increased that went into those markets, if you want to hold someone accountable, you're probably looking at me.
No
So I'm not
question.
going to blame
Or
the staff
ourselves.
for
No
that.
question,
Right, or the
no
board.
question, or ourselves, but I'm just saying, I'm saying, so, had we been smart, we should have maybe allocated 0 or 2% or something. But let's just say on an asset class that we allocated 10% with a range of 9 to 11. Then I'm saying staff should be held accountable to decide whether to be down at 9 or be up at 11.
I agree with you completely.
But to the extent that we say you gotta be at least 9 and then that asset class crashes, well, that's on us, that's not on staff.
But I think the way you're going to deal with that's going to be more of a challenge quantitatively, but qualitatively, you've set a target. And the CIO should be looking at it. Has the private equity staff moved to that target? If they haven't, did they use good judgment and not, or not good judgment? But that's, to me, the qualitative component. Because the quantitative component, you're not going to know for a decade whether or not they were good decisions.
So,
We can't wait that long.
Well, but that's
For
why I
purposes
think,
of actually managing the fund, we can't
but
wait.
that's why I think the qualitative component, it becomes more and more important, the less available pricing data is.
all right, so Chris, before you answer, because I think we're delving into a benchmark conversation that we probably should be having with the whole investment committee, not just comp committee. And I want to be sensitive of our time. We're about 25 minutes over time on this item alone. And so, and if I'm totally off on that, let me know, but I think it's a bigger conversation than what we had for our presentation, and we still have quite a bit to go in the presentation. So, Chris?
My comments actually dovetail with yours, because I was thinking more
Absolutely.
global in my perspective. So Paul, I'm responding to your earlier question you asked, Alan, you're spot on. The investment committee defines benchmarks. It used to be in our investment policy. I think there's still something in there about benchmarks. It used to be quite long to describe how we pick benchmarks. When you do the asset allocation coming up next year, you pick an asset class. Global equities is the easy one. You make an assumption about what that's going to do in the future. A lot of that has to do with how you define that, how much USA and how much the rest of the world. That then leads us to a benchmark. And the investment committee uses that as a measurement tool to measure how well they forecasted that, but also how did we implement it. You've got to keep in mind, and Dana hit the point, compensation, and that's why Melissa sits here, it's a human resource tool. It is a way that you want to motivate staff. I like it when there's alignment with what the investment committee is doing. The best thing I can give you, Paul, is a tangible asset class. So global equity, like Alan said, daily priced, every night we know what it is. Fixed income, pretty darn close. But fixed income, for Karen's sake and Jacqueline's, is even hand calculated, because some bonds don't trade every day. But forget the other ones. Picture infrastructure. Infrastructure is not even an asset class. The asset class is inflation sensitive. So it's a basket of stuff. Some daily priced. Within infrastructure, think about bridges, because that's a great one. We own bridges and pipelines. They're not mark to market. They don't sell and transact very often. So we there's not we want a benchmark to define the investable universe, but nobody publishes data on bridges for sale in the world, and more or less just within the United States. So that's where we run into these problems of how do you define that investable universe? And we end up using things like CPI and surrogates. And that's what we've done in private equity. And we did originally in real estate, but infrastructure is a good one where we have to use a surrogate to describe that asset class. And that's where it gets uncomfortable and uneven, because we're not clearly defining the investable universe. You can't buy and own the universe. and then therefore judge how, like you said, out of the 50 bridges, staff only bought 5, did they buy the right 5? And that's where, and I wanted to just say, Dan, the investment committee, you've already asked the investment committee to have a benchmark education, and we're gonna do that, where we get into transparency, construction methodology, the investable universe definition, be really easy in a couple of them, and then it gets really sticky in our bucket asset classes, where even the asset class, RMS and inflation sensitive, aren't a thing. And you gotta then sub-measures to measure the one bucket. So it gets hard.
And Paul, I agree. I think you're bringing up really important points and things that we really need to delve into. I'm just not sure the committee is the right place to do it.
Okay.
I mean, and I know that there's a tie between compensation, so it's hard not to think about it in terms of compensation. But I think that's part of the bigger conversation we need to have on benchmarks. And what we want to try to do today is look at what we're doing and then decide if we want to develop a process to do something differently. Okay. So,
Dana, I don't want to slow, I'm not saying this to slow down the committee, but you're doing fine on time. This is a 45-minute session. We're scheduled to go to about 10:15, so I didn't want to restrict any dialogue about this.
okay, as long as you think you're gonna have enough for the evaluation and delegation of authority. All righty. Thanks, I appreciate that, Melissa. Go ahead, Alan. Because I know you had one more slide, right? I know Luis jumped ahead, but,
No, I'm good.
okay.
He passed me the baton, so I thought he was fine.
I think the slide that we skipped is just basically saying we do what other funds do and using the same benchmarks. One for the investment side, and then also using that for investment incentive performance evaluation. All righty, go ahead.
So again, just to remind everybody, this whole section is not talking about what CalSTRS does, et cetera. This is, in terms of best practices in market and that. And I think, something that we pay a lot of attention to in terms of GGA for CalSTRS or anybody, frankly, is making sure that people understand the philosophy around performance pay. So, human nature is human nature. People at times in certain organizations think that, my bonus should be maximized and earned every year. That's not the way it's supposed to work. The bonuses are meant to be challenging. They're meant to be in addition to your salary. And what we work all together here to do is to make sure that there is alignment in terms of the risk profile, the level of difficulty of attainment, and kind of matching that to the compensation opportunity that's available to somebody. And so if you look at this slide, you've got the internal review, which is more what GGA handles, and then you've got the external review, which is more of what Steve and Alan handle. And that overlap of the two is very important in the sense that, you don't want to have a practice or a system where, somebody says, oh, geez, I didn't hit my benchmark this year, so we should reduce it because I need to get my bonus, right? You can't have that type of mentality and structure because at the end of the day, again, it goes back to high level pay for performance. And so if Dana or whoever it is communicating to a key stakeholder group, this is why we paid our bonuses out this year. This was what was achieved for our stakeholder group, our pensioners. There has to be a great message there. You can't be in a situation where Dan is standing up and communicating to stakeholder groups. We've maxed out our incentive pay this year, but we had bottom decile performance as a group. That's not going to fly. And so I think, in terms of best practice, you've got that overlap that I think, historically has actually worked quite well. But there is that kind of a fair bit of teamwork that's required to make sure that, that gaming and that great message in terms of linkage is there. Oh, so this looks like the same slide as earlier, but it's meant for a different reason. again, this is all about market practice and best practice, and frankly, what you're doing is best practice. So market practice is having a board and the compensation committee covering all staff in terms of the measures. So again, it doesn't matter if you're an asset manager or a not-for-profit or a for-profit or a publicly traded company, whatever your strategy is, be it your investment strategy or corporate strategy, you want to make sure that you're filtering that through the incentive pay structure so that everybody is aligned. Obviously, there will be different weightings. The CEO and the CIO will have a much higher weighting towards the key principles of the strategy than, say, a very junior level associate. But at least you're carrying that message through the organization so that everybody understands, why those bonuses are being paid out. Why are we all here? In this case, obviously, it's to make sure that we can meet the pension promise.
So and when I started, I said, we work for you, and this is an indication of that. At the end of the day, the investment committee sets all the benchmarks. It's derived from the strategic asset allocation. The process is initially there's a discussion with the staff and the various consultants. There is generally a consensus, sometimes there's not. That's brought to the board for your consideration with the pros and the cons. But the important thing here is you set that benchmark based upon input from your consultants acting for you. The staff participates in that process, but they do not drive it.
Slide. So, committee board, the benchmarks, but the benchmarking that I remember the board doing has been in the investments committee. Have we done separate benchmarking in compensation, or have we just built a compensation system based on the benchmarks that have been adopted at investments?
My recollection, it's all been done at the investment committee.
Okay, so, go ahead.
I think the nuance there is that the comp committee addresses the margin on top of the benchmark for performance purposes.
Right.
And that's regularly reviewed and often, bubbles up annually.
Okay, but then the benchmarks are ones driven by
The investment.
the investment committee, and therefore the consideration of the investment committee to measure performance of the fund as opposed to measuring performance of the staff? Or are we not making a distinction there?